This lecture we're going to look at different alternative sources of finance for companies and individuals looking to sort of grow and develop the next new thing, their business. So let's say, and I'm sure many of you actually thought, well, I'd love to go and set up my own business. Maybe it's sort of making candles, for example. So once you've got the initial idea that you're going to have the next scented candle, the next candle in a glass, or whatever it may well be, you need to start thinking about how you're going to raise money. Well, historically, many people have turned after their own financial resources. They then turn to family and friends. Once that capital is exhausted, historically, they'd have actually gone to a bank. Unfortunately, as many of us know, banks are fairly reluctant to raise and lend capital. So an alternative source of finance is then to look at more specialist angel investors, for example, or you may do some sort of crowd financing. If your business starts to grow and you start getting some real traction and revenue, then you might go and talk to a venture capitalist. And these are specialist funds that are actually looking to invest in sort of ideally fast-growing businesses. Another source of finance might be private equity, where again they're looking to invest equity into private companies, hence the name. Or maybe an alternative would be to putting money with specialist fund managers, say with a hedge fund manager. And as your business grows and develops, you may well then start looking at something called an initial public offer, which is an IPO. So many of you may remember your parents or your grandparents actually being given shares in British Gas, BP, as the UK government privatised various different shares, and they effectively took the companies out of state ownership and put them into public ownership and did something called an IPO, an initial public offering. Well, what we're now seeing is a completely new asset class that's been created and a new way of raising money, and it's called an initial coin offering. So you're actually bringing your cryptocurrency, your coin, to the market, to the public, and they can invest for a relatively small sum of money. Now, it's quite interesting because whilst this has been the preserve of smaller investors, and as I said before, typically younger millennial type investors, i.e. people below 40, what we're now seeing is in an institutional space where fewer and fewer companies are evolving and growing and then being listed through an IPO onto the stock exchange. Because the costs of listing and the financial constraints and the due diligence and just generally the hassle of actually putting your company in the public market has put many people off. And the banks and the brokers and the lawyers are saying, look, unless it's 500, unless it's ideally $1 billion, we really don't want to get involved. So it leaves certainly medium-sized businesses very little avenues and little place to actually raise more capital or use a public offering as a way to ease out maybe the founders. You're bringing in the new team that will take the business from just a concept and idea to a fully fledged growing business which may be looking to expand overseas or something like that. So initial coin offerings, what they're doing, they're giving you an alternative source of finance, and by default they've created actually a new asset class. But we'll turn to that in another lecture.